Hi, I'm Pattu from freefincal. Today let's talk about portfolio rebalancing once again, and in particular answer if I wish to rebalance, should I use the best performing mutual fund to rebalance or the worst performing mutual fund? This is a question that's been asked many times to me before. I sometimes I get puzzled why people ask this question, but then I realize it's probably because they don't look at the whole idea of rebalancing in the right manner. So let's talk about rebalancing. I have talked about why one should rebalance, whether there is a tax involved or not, whether there is an exit load involved or not, and I have also given examples of portfolio rebalancing. But every time there will always be some comment saying, please give me an example of portfolio rebalancing. I don't know, it's a trivial example. I mean, it's just you have to look at your equity allocation, you have to look at your fixed income allocation, find out the current allocation, find out the target allocation, and find out how much you need to change the current allocation to get to the target. What is there in this to write down examples about? I have done that as well, but it just baffles me. It's a very trivial exercise, but there's a lot of mental block associated with this and probably emotional biases as well. Anyway, so portfolio rebalancing, as most of you know, is some kind of a system reset where you say, look, I'm going to have 50-50 of equity and fixed income, and then after a year or so that becomes, let's say, 60% equity and 40% fixed income. I have to remove 10% and put it into 10% from equity and put it into debt or fixed income. This is not profit booking. It's childish to say that rebalancing is profit booking. When you are investing in a capital market linked security, there's no such thing as profit. You can't separate out this is profit and this is the principal, that's the money invested. That there's no way you can separate. All you know is you're going to it's just a matter of FIFO, first in first out. The units that you purchase first will be redeemed out first, and there will always be a mixture of the principal and the capital gains involved. They will always be mixed with each other. There is no such thing as profit booking. Please don't call rebalancing as profit booking. It's childish. And the second point is that you have to recognize that rebalancing is with respect to asset class. You have to look at the whole act of rebalancing with respect to the portfolio, with respect to the target allocation. It is because many people refuse to do this that they get into trouble. And let's look at different situations. So I have talked about what is rebalancing, how to rebalance, why you should rebalance, etc., etc. I have given there are a lot of examples for this. There are videos on this. If you go to the community page, the link is there. You can go and access them as well. Now, the first thing is that most portfolios are cluttered. They have there's going to be one mutual fund too many in it, one stock too many in it, and the first time you rebalance, or probably the first couple of times, you can actually use the rebalancing as an opportunity to declutter your portfolio. So the first thing you should be clear is what is your target asset allocation. Many people have difficulty even in this. Then you should understand that in my portfolio, what kind of portfolio is it? What is the market cap I want to target, or should I have a diversified portfolio across market cap? Some people prefer large capish market kind of portfolio, or even large mid cap, something like that. You must have some plan. My point is, have a plan. Then you must, if you are looking at stocks, you have to also worry about the sector diversification. What kind of sectors I want, what kind of sectors I don't want, or more of, less of, etc., etc. Many people think that stock portfolio rebalancing or stock portfolio management is fundamentally different from mutual fund portfolio. That is not true at all. They are identical as long as you are aware of the basics and you look at it, you have a bird's eye view at an asset class level. So once you recognize, look, I have 5 funds and I don't need 2 of those funds. In the 3 funds, I can get a good diversification. then you use the rebalancing to get rid of two funds. It doesn't matter whether they are good performers or bad performers. Sometimes you may have to retain a worst performer or a poor performer because it will provide the diversification benefit. Or sometimes you can say, look, that fund, let's say you have a value fund, that fund is good, but that category of fund I need, but that particular fund, that category of fund I need, but that particular fund is not doing well, so I have to replace it by another fund. So that also will occur. So you will have to make these kind of decisions, and then you can use the first couple of times to declutter your portfolio and carry out the rebalancing. So when you have a cluttered portfolio, the first couple of times, reviewing individual stocks or individual mutual funds and rebalancing those two can be combined together to form a leaner, meaner kind of portfolio initially. After that only this question, that worst fund or best fund kind of question makes sense in my opinion. But also you must recognize that portfolio management has got two aspects. One is rebalancing, that is at the asset class level. The other is a portfolio review, where you are reviewing every fund, reviewing every stock, every security that you are holding, etc. That is in general, those two are distinct actions. Portfolio review and portfolio rebalancing are two different actions. Portfolio review is within an asset class, rebalancing is between two asset classes, to keep it very, very simple. So you must understand that distinction as well. So only when you have developed a diversified portfolio should you actually worry too much about worst fund, best fund, and so on. Before that, it's just a matter of use the rebalancing opportunity to declutter the portfolio. I don't know how this might sound like a lot of theory and so on, but that's how it is. I mean, you have to, I don't know what else I can do. I can show you examples, but that's not, I don't think that's going to help in any manner. For example, to give you a very crude example, you may be holding one, for example, let's say you are holding 3 large cap funds, or you may be holding 3 ELSS funds, or you may be holding 3 multi-cap funds, 1 large and mid-cap fund, 1 large cap fund, 1 mid-cap fund. Now you have to decide, what am I going to do? Am I going to have 1 large cap and 1 mid-cap, or am I just going to have 1 or 2 multi-caps? It's your portfolio. You will have to decide that and then use the rebalancing to trim out the portfolio. So then you have to worry about only when you have the bare essentials that are minimalistic portfolio, then only you have to worry about this titular question of worst fund or best fund. In general, typically in the stock market, if the large caps do well, let's say you have a large cap and mid cap portfolio, if the large cap segment does well, the mid caps will also do well, maybe to different extents. So typically speaking, when the stock market is up, then only your asset allocation will, let's say from that 50% equity, it has gone up to 60%. That will happen only when the stock market has gone up. And when the stock market has gone up, typically all segments will tend to do well. Then there is no need for you to worry about best performer or worst performer. If you are still asking, should I book profit, like people say, or should I rebalance from my best fund or the second best fund and so on, it really doesn't matter too much. In the most typical situation where all the funds are doing well, you can just take out money, redeem, not book profit, redeem in equal percentages, which will be the simplest thing to do. What has happened from February 2018 to March 2020, like I keep saying, there's been a stock market imbalance. The large cap has been doing well, segment has been doing well based on just a few stocks. The mid cap and the other small segments have not done well. In that case, you would have had a discrepancy where your large cap funds would have given you much better returns than the mid cap. Then what would I do? Should I book profit from I keep saying that, should I see, that's just force of habit, from should I redeem from large caps or should I redeem from mid caps? Now is where you look at it from the asset allocation level. See, you have mutual fund or a couple of stocks that have done well. Your aim is to reduce risk in that portfolio. Therefore, naturally, you have to go and get some money out from the well-performing fund. So there's no problem there. Of course, there will always be some questions like, look, I have some security which is in loss, some mutual fund is in loss, some stock in loss. If I use that for rebalancing, I can reduce tax and so on. Yes, yes, but the point is, saving tax is only a secondary goal. If you have gained profits, and if you want to safeguard those profits into fixed income, because rebalancing is not just at the asset allocation level, it also has to be goal based, because you are building a corpus for a goal, and with respect to that goal, it's always better, it always makes sense for you to take money out of a well performing asset and or security and put it into something else. So that maturity you should need. Rebalancing requires the mental maturity of taking money from a well performing fund or a stock and putting it into something else. You have to be emotional about the risk associated with your corpus building, and not not the performance of that stock, or say, let's just wait a little more and wait for the returns to go up, and don't have that attitude, and then you might be more risky. So only in these special situations you have to worry about best fund, worst fund. Generally you don't have to worry about is once you have the portfolio decluttered. Even then I would suggest take it from the funds that have given you the maximum profit, because that's when you have to worry about rebalancing. Otherwise there's no point in worrying about rebalancing every year. Which brings me to the final point. Already taken too long of your time. The final point is, you don't need to rebalance every year. See, if you have a 50-50 equity debt allocation, up to about 5%, 7% variation, you don't need to worry. So next year it becomes 52% equity, 48% fixed income, don't do anything, leave it alone. After, if it goes beyond the 55% or beyond 57% or beyond even 60%, whatever you define as your threshold level, then only you do the rebalancing. That will reduce your impact of taxes and so on. And that's good enough, I think, for a very long term goal. Initially, for the first few years you can do that, but when you are getting closer and closer to the goal, your asset allocation also will change, your equity will reduce, then you can regularly do rebalancing as well without worrying about deviations, because even if you get 1-2% extra towards the end of the goal, that gain will make a difference in terms of risk management. So I've spoken enough. Bye bye.